Hey, everyone, I need to tell you something that might be difficult to hear, especially if you think you own gold right now. There's a lie sitting at the foundation of the global gold market, a $4 trillion lie. And it affects millions of people who believe they have gold safely stored in a vault somewhere with their name on it. They don't. What they have is a promise, a claim, a piece of paper that says gold exists for them. But when you dig into the actual vault data, when you examine how the system really works, you discover something disturbing. The gold they think they own doesn't exist, at least not in the quantity they've been told. This is the unallocated vault scandal. And today, I'm going to expose exactly how it works, who's responsible, and what it means for your financial security. Before I break this down, let me remind you what this channel is about. We don't do conspiracy theories without evidence. We don't do sensationalism for clicks. What we do is examine market structure, analyze publicly available data, and explain what institutions don't want you to understand. Today's video is exactly that. This isn't speculation. This is how the gold storage system actually operates. It's documented, it's legal, and it's a scandal hiding in plain sight. If you're new here, welcome. You found a channel that respects your intelligence. If you've been with me for a while, you know we expose uncomfortable truths. Let's get into it. So what is this $4 trillion lie? Let me explain from the beginning so everyone can follow. When most people buy gold, they don't take physical possession. They open an account with a bank, a broker, or a bullion dealer. They pay for gold. They receive a statement saying they own gold. And they assume that gold is sitting in a vault somewhere, waiting for them. For some accounts, that's true. These are called allocated accounts. Your gold is specifically identified, serialized, and segregated. It's yours. Nobody else can claim it. But for the majority of gold accounts, that's not how it works. These are called unallocated accounts. And here's where the lie begins. In an unallocated account, you don't own specific gold bars. You own a claim against the institution. You're a creditor, not an owner. The institution promises to deliver gold to you on demand, but they don't actually hold your gold separately. In fact, they don't have to hold your gold at all. They operate on a fractional reserve basis. Just like banks don't hold all depositors' cash, gold custodians don't hold all clients' gold. They hold a fraction. They assume that not everyone will ask for delivery at the same time. And for decades, that assumption is held. Most people never ask for physical gold. They just look at their statement, feel secure, and leave the gold in the vault. But here's the math that reveals the lie. Industry analysts estimate that the total claims on gold through unallocated accounts exceed $4 trillion globally. The actual physical gold available to back those claims? A fraction of that. Some estimates suggest the ratio is 10 to 1. Others suggest it's higher. For every ounce of physical gold in the vault, there are 10 or more ounces of claims against it. That's the $4 trillion lie. Millions of people think they own gold. What they own is a promise. And there isn't enough gold to keep that promise if everyone asks at once. Now let me explain how this system developed, because it didn't happen by accident. It was designed this way. Number one, the cost advantage. Allocated storage is expensive. You pay for vault space, insurance, auditing, and segregation. Unallocated storage is cheaper because the institution doesn't actually have to hold your gold separately. They can use that gold, they can lend it, they can leverage it, and they pass some of those savings to you through lower fees. Most retail investors choose unallocated because it's cheaper. They don't read the fine print. They don't understand the difference. They just see lower fees and assume it's the same thing. Number two, the legal structure. In an unallocated account, you are legally a creditor of the institution. If that institution goes bankrupt, you stand in line with all the other creditors. You don't have a claim on specific gold. You have a claim against the company. And in bankruptcy, creditors often get pennies on the dollar. This is in the terms and conditions. It's disclosed. But nobody reads the terms and conditions, so people walk around thinking they own gold when legally they own a corporate IOU. Number three, the rehypothecation game. This is where it gets really problematic. Institutions that hold unallocated gold can lend that gold out. They can use it as collateral for their own borrowing. They can lease it to other institutions who can then lend it again. The same physical gold bar can be claimed by multiple parties simultaneously. It's in Vault A, but it's been lent to Institution B, who used it as collateral with Institution C, who sold a claim on it to Investor D. 1 bar, 4 claims. That's rehypothecation. That's the engine behind the $4 trillion lie. Number 4, the audit problem. How do you audit a system where the same gold is claimed by multiple parties? You can't. The auditing standards for unallocated gold are fundamentally inadequate. Institutions self-report. Third-party audits, when they happen, often count gold that has multiple claims against it. The system is designed to obscure, not reveal. Number 5, the incentive structure. Banks and custodians make more money from unallocated accounts because they can leverage your gold. They have no incentive to encourage allocated storage. They have every incentive to keep you in the unallocated system, collecting fees while using your gold for their own purposes. That's how the system works. It's not a bug, it's a feature. So what happens when the system fails? Let me walk you through the scenario because it's not theoretical. We've seen glimpses of it before. Here's how it unfolds. A crisis hits. Economic uncertainty, banking instability, currency concerns. People who own gold suddenly remember why they bought it. They want it. Not a statement, not a promise. Physical metal in their hands. They call their bank. They request delivery. And they're told, we need 30 days. We need 60 days. There's a queue. We're processing requests in order. Some people wait. Some people get nervous. More people request delivery. The queue gets longer. Rumors spread. Panic builds. And then someone doesn't get their gold. The institution admits there's a shortfall. The claims exceed the physical gold. Not everyone can be made whole. What happens next? The people who didn't get delivery become unsecured creditors. If the institution survives, they might get cash at the current market price. If the institution fails, they stand in line in bankruptcy court. They might get 50 cents on the dollar. They might get nothing. Meanwhile, the price of physical gold explodes because now everyone knows the truth. Paper claims are not gold. The market bifurcates. Paper gold trades at one price. Physical gold trades at a massive premium because it's real and paper isn't. Those who held allocated gold or physical metal in their own possession are protected. Those who trusted unallocated accounts are devastated. This isn't fantasy. This is exactly what happened in smaller cases. MF Global, ABN AMRO suspending physical delivery, Perth Mint delays. These were warning shots. The system creaked. It didn't collapse entirely, but the vulnerabilities were exposed. The question isn't if this happens on a larger scale. The question is when. Now let me show you how we verify these claims, because I don't expect you to believe me without evidence. Number one, the account terms themselves. Go read the terms and conditions of any major unallocated gold account. It explicitly states that you are an unsecured creditor. It explicitly states that your gold is not segregated. The disclosure is there. It's just buried in legal language. Number two, industry research. Organizations like the World Gold Council and LBMA publish data on gold flows, vault holdings, and trading volumes. When you compare daily trading volume to actual vault inventory, the math doesn't work. There's more gold trading than exists. That's only possible if the same gold is being claimed multiple times. Number three, historical incidents. MF Global collapsed in 2011. Clients who thought they owned segregated assets discovered they were just creditors. They lost money. Some lost everything. The precedent exists. Number four, central bank leasing data. Central banks lease gold to commercial banks. That leased gold gets rehypothecated into the system. The same gold that's listed on a central bank balance sheet is also being claimed by private investors through unallocated accounts. Number five, whistleblower testimony. Former employees of major bullion banks have spoken publicly about the practices. They've described the fractional reserve nature of unallocated accounts. They've explained how the same gold services multiple claims. The evidence is there. You just have to be willing to see it. Now, I know some of you are thinking, John, if this is so bad, why hasn't it collapsed already? Why hasn't there been a major default? Fair question. Here's my answer. The system survives on confidence. As long as most people don't ask for delivery, the fraction is enough. As long as people trust their statements more than they distrust the system, nobody tests the limits. It's like a bank run. Banks survive as long as depositors believe their money is safe. The moment everyone asks for their money at once, the bank fails. It was always fractional. It just wasn't tested. The gold system is the same. It works until it doesn't. And when it stops working, it stops all at once. Also, institutions have tools to delay the reckoning. They can settle in cash instead of metal. They can impose delays. They can change terms. They can force you to accept alternatives. These measures buy time, but they don't solve the underlying problem. The $4 trillion lie persists, because most people don't know it exists. Now you do. Let me be clear about risk, because this information demands action, and action carries risk. First, for my USA audience, nothing in this video is financial advice. I'm not telling you to close your unallocated account tomorrow. I'm educating you about how the system works. Second, allocated storage costs more. If you switch to allocated, understand the fee structure. Make sure it fits your budget. Third, physical possession has its own risks. Theft, loss, insurance costs, storage challenges. It's not a perfect solution for everyone. Fourth, verify before you act. Don't trust any institution blindly. Read the terms, ask questions, demand clarity, understand the risks on all sides. So how do you protect yourself? Let me give you concrete steps. Number one, know what you own. Pull out the terms and conditions of every gold account you have. Search for the words allocated and unallocated. Know which category you're in. Number two, ask questions. Call your custodian. Ask them directly. Is my gold segregated? Is it specifically identified to me? Can you provide bar serial numbers? Their answers will tell you everything. Number 3, consider conversion. If you're in an unallocated account, explore the option of converting to allocated. Yes, it costs more, but you'll actually own what you think you own. Number 4, consider physical possession. For a portion of your gold holdings, consider taking physical delivery. Gold in your possession cannot be rehypothecated. It cannot be claimed by creditors. It's yours. Number 5, diversify custody. Don't keep all your gold with one institution. Spread it across multiple custodians and jurisdictions. Reduce single point of failure risk. These steps won't protect you from every scenario, but they dramatically reduce your exposure to the $4 trillion lie. If this expose opened your eyes to how the gold system really works, please subscribe. Not for my growth, for your protection. When the next crisis hits and people start asking questions about their gold, you want to have already asked those questions. You want to have already verified your holdings. You want to be prepared, not panicking. That's what this channel provides. Truth before it becomes headline news. Drop a comment below saying checking my accounts or going allocated. It helps new viewers find real analysis, and it tells me this information is reaching the people who need it. Here's my promise. I'm going to keep exposing the uncomfortable truths about how financial systems really work. I'm going to keep explaining what institutions don't want you to understand, and I'm going to keep respecting your intelligence enough to tell you the hard stuff. The $4 trillion lie exists because most people don't ask questions. They trust statements. They trust institutions. They assume the gold is there. Now you know the truth. The gold you think you own might not exist, and the only way to know for sure is to verify. Gold investors, you now know how the system works. You know the risks. You know the protection steps. Don't wait for a crisis to discover you were just a creditor all along. Stay sharp, stay protected, and I'll see you in the next update.